Jason Corporation completed, its board of directors authorized, and it issued its financial statements following IFRS for the year ended December 31st, 2020 on March 10th, 2021. The following events took place in early 2021. On January 30th, 19,000 common shares were issued at $45 per share. On March 1st, Jason determined, after negotiations with the Canada Revenue Agency, that income tax payable for 2020 should be $1.2 million. At December 31st, 2020, income tax payable was recorded at $1.0 million. Discuss how these subsequent events should be reflected in the 2020 financial statements. Okay, well, we have two different types of subsequent events here. So the first relates to something, issuing common shares relates to something that happened after the statement of financial position date. So we would just disclose that in the notes of the financial statements. And the fact that income tax payable was under recognized. So we recognized 1 million and now Jason found out that it should be 1.2 million, means that this provides additional evidence about a condition that existed at the statement of financial position date. So we would go back and correct this amount in the financial statements. So B says the controller of Jason Corporation believes that the income tax payable as at December 31st, 2020 should not be increased to 1.2 million because the original estimate of 1 million was based on information available at the time of the accrual and recorded in good faith. The controller feels that the revised estimate of 1.2 million should be treated prospectively as a change in estimate. Do you agree or disagree with the controller's proposed accounting treatment of the income tax payable as at December 31st, 2020? Discuss your conclusion from the perspective of the investors. Well, the income tax payable at December 31st should be increased to 1.2 million because the information about the increased estimate is available before the financial statements were authorized, and it provides additional information about a transaction that was recorded in the financial statements. And the investors rely on the financial statements to assess the company's performance, make their investing decisions, and predict future cash flows. Therefore, investors would support increasing the estimate of the income tax payable, as they may make their decisions based on financial statements that are irrelevant. They need the financial statements to be free from error. And C says, would your answers to part A and B differ if Jason Corporation had been following ASPE? And the answer is no, the answers would not change. The only thing that's different on ASPE is that it's really around when the financial statements are issued, but here the statements are issued. So everything is exactly the same.